Hey there, welcome back to our channel, the place where we make finance easy and approachable. And today, I'm excited to talk about something that stumps a lot of us, dividend yield and dividend growth. You see, when it comes to investing, dividends can quietly build your wealth, or they can lead you down a path you didn't intend to take. But what's the better approach? Chasing those stocks with high dividend yields or playing the long game with stocks that promise growing dividends? It's a question that can change the game for your investment strategy. So if you're looking for the right answer that will help with your investment decisions, hit that subscribe button and keep watching. Understanding dividends. All right, let's kick things off with dividends. You've likely heard about them in the investment world, but what are they really? Dividends are either cash or additional shares given to shareholders, a way for companies to share profits with investors. Not every company pays dividends. It's usually the well-established and consistently profitable ones that do, reflecting financial stability. These companies can afford to pay out part of their earnings while reinvesting the rest. So why should investors care about dividends? They're a stable income source, especially in uncertain markets, and signify a company's health and growth potential. Reinvesting dividends can also boost long-term returns due to compounding. But be cautious. High dividends might look attractive, but aren't always a mark of a sound investment. A high dividend yield can sometimes signal company troubles. It's important to consider the full picture. What is dividend yield? All right, now that we've got a good grip on dividends, let's turn our attention to a term called dividend yield. If dividends are the what, then dividend yield is the how much. So, what is dividend yield? It's a way to measure how much bang you're getting for your buck when it comes to dividends. Let's break it down with an example. Imagine you buy a stock for $100 and it pays you a $5 dividend over the year. Your dividend yield would be 5%. Simple, right? But here's where it gets interesting. Dividend yield isn't a static number. It changes with the stock price. If the price of that stock drops to $1.50 and it still pays a $5 dividend, your yield shoots up to 10%. Sounds great, but higher isn't always better. We'll touch on why that is in a bit. Now, dividend yield can be a handy tool for comparing stocks. It gives you a quick snapshot of what kind of income you can expect relative to the price you're paying for a stock. But, and this is a big but, it's not the only thing you should be looking at. A high yield might catch your eye, but it's like seeing a shiny apple on that tree. You've got to check if it's healthy or if there's a worm lurking inside. Why do I say that? Well, a high dividend yield can sometimes be a red flag. It could mean the stock price has fallen a lot, and not necessarily because the company is being extra generous with its dividends. Maybe they're facing some challenges and investors are losing confidence. That's why it's crucial to do your homework and look beyond just the yield. But it's not all doom and gloom. A stable, reasonably high dividend yield can be a sign of a solid, profitable company that's committed to sharing its success with shareholders. These are often established companies in industries like utilities or consumer goods, sectors where wild swings and disruptions are less common. Here's something else to keep in mind. Dividend yields can vary widely across different industries and sectors. Tech companies, for example, might have lower yields or not pay dividends at all, preferring to reinvest profits back into growth. On the other hand, real estate investment trusts, or REITs, often have higher yields because they're required to pay out most of their earnings as dividends. The allure of high dividend yield. Let's be real. Who doesn't like the idea of getting more income from their investments? That's exactly what high dividend yields promise. But as the old saying goes, if it sounds too good to be true, it probably is. Let's unpack that. First up, why are high dividend yields so appealing? Let's say you invest in a stock with a high yield, and it's like you're sitting under a money tree, catching dollar bills as they fall. Sounds dreamy, right? High dividend yields can offer a significant source of income, especially attractive if you're looking for cash flow, like in retirement. They can also be a cushion during market downturns, providing a steady income even when stock prices are falling. But here's the twist. High yields aren't always a bed of roses. Sometimes they're more like a warning sign flashing in neon lights. A high dividend yield can be the result of a stock price taking a nosedive. And why might a stock price fall? Maybe the company's future earnings are in question or it's facing some big challenges. This scenario is what investors call a dividend trap. It's like seeing a big, juicy apple on a tree, reaching for it, and then realizing it's rotten. Another thing to consider is opportunity cost. Investing in high-yield stocks might seem like a safe bet, but what if those companies aren't growing? Your investment could be missing out on potential capital gains from companies that reinvest profits into growth rather than paying out high dividends. Also, let's talk about the economic environment. In periods of low interest rates like we've seen recently, high dividend yields become even more attractive compared to the returns from bonds or savings accounts. But as interest rates rise, which they inevitably do, high-yield stocks might lose some of their luster as other income-generating investments become more competitive. While the allure of high dividend yields is undeniable, it's crucial to look beneath the surface. High yields can be a sign of a company's generosity, but they can also signal financial distress or a lack of growth opportunities. Understanding dividend growth. Okay, let's shift gears and talk about the other side of the coin, dividend growth. If high dividend yield is like grabbing the biggest, ripest apple from the tree, dividend growth is more like planting your own apple tree and watching it grow over the years. It's about the long-term game, and for many investors, this is where the real magic happens. So, what exactly is dividend growth? It's when a company not only pays dividends, but regularly increases them over time. It's like getting a raise every year just for holding on to your shares. Companies that can do this consistently are often seen as the cream of the crop in the investment world. Now, why does dividend growth matter? First off, it's a sign of a company's health and confidence. A company that's consistently boosting its dividends is likely doing well financially. It's making enough profit not just to pay dividends, but to increase them. This can be a strong indicator of a stable, well-run business. But here's where it gets interesting. Dividend growth can have a profound impact on your investment returns. Thanks to the power of compounding, even small increases in dividends can add up to significant sums over time. Imagine a snowball rolling down a hill, gathering more snow, and getting bigger as it goes. That's what your investment can do with reinvesting dividends from a company that's regularly increasing them. Say you invest in a company whose dividend grows by an average of 6% per year. At first, the increase might seem small, but over 10, 20, or 30 years, that growth can turn your initial investment into a much larger sum than if the dividends had remained flat. But wait, there's more. Dividend growth investing isn't just about the immediate income. It's also a hedge against inflation. As prices rise over time, a growing dividend can help ensure that your income keeps up with the cost of living. That's crucial for long-term investors, especially if you're looking at your portfolio as a source of income in retirement. Now, it's important to note that not all companies can sustain dividend growth over the long term. It takes a special kind of business model, one that generates consistent, reliable cash flow. These are often companies in stable, mature industries. Think consumer goods, utilities, or healthcare. Understanding dividend growth is key to building a robust, future-proof investment portfolio. It's not just about the income you receive today, but about growing that income for tomorrow. It's about finding those companies that aren't just profitable now, but have the potential to be even more profitable in the future. And in the world of investing, that's as good as gold. The power of compounding in dividend growth. This is where things get exciting and where the seemingly small decisions we make today can have huge payoffs down the road. First off, what is compounding? It's when you earn interest on your interest, or in our case, dividends on your dividends. It's like planting a seed that grows into a tree, which then produces more seeds, leading to more trees, and so on. This cycle of growth upon growth can turn your investments into a forest of wealth over time. Now, let's bring in the dividend growth part. When you invest in a company that's increasing its dividends year after year and you reinvest those dividends, you're not just compounding your returns, you're turbocharging them. Because not only are you earning dividends on your original investment, but you're also earning dividends on the increased dividends from the previous years. It's a double whammy of growth. And here's another cool aspect. Compounding with dividend growth can be a great hedge against inflation. Over time, as the cost of living rises, so can your dividend income if you've invested in the right companies. This can provide you with a growing income stream that maintains or even increases its purchasing power over the years. Now, a word of caution, compounding works wonders over long periods. It's not a get-rich-quick scheme, but a get-rich-surely strategy. It requires patience, discipline, and the ability to stay the course even when the market gets rocky. The power of compounding in dividend growth is one of the most compelling reasons to invest in dividend-growing stocks. It's about making your money work harder for you, not just today, but decades into the future. As Einstein supposedly said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. In the world of dividend investing, understanding and harnessing the power of compounding is the key to unlocking long-term financial success, balancing yield and growth. Now, let's talk about striking the right balance between yield and growth. First off, diversification is your best friend. Don't put all your eggs in one basket. Mix it up. Include a variety of dividend stocks in your portfolio, some with higher yields and some with strong growth potential. This approach helps you manage risk while still capitalizing on the benefits of both strategies. Then, there's the art of research. Look for companies with a history of steady dividend increases and solid financial health. These are often indicators of a company's ability to continue growing its dividends, but also peek into their future potential. Are they innovating, expanding into new markets? This foresight can give you an edge. Consider also the economic context. Different market conditions favor different strategies. In a low-interest rate environment, higher-yielding stocks might be more attractive. But when rates rise, growth-oriented dividend stocks might hold up better. Remember, there's no one-size-fits-all answer. Your personal financial goals and risk tolerance play a huge role in determining the right mix for you. Are you looking for steady income now or building wealth for the future? Your answer to this question can guide your strategy. To sum up, both dividend yield and dividend growth have their pros and cons. Your choice depends on your financial goals, risk appetite, and investment horizon. Remember, investing is a personal journey, and there's no one-size-fits-all strategy. Did this video help clarify the dividend yield versus growth debate for you? What's your dividend investment strategy? Share your thoughts in the comments below. And if you found this video helpful, don't forget to like and subscribe for more finance insights.